Hello traders, it's Friday, January the 31st. This is John Kicklighter, Chief Strategist for dailyfx.com. Here to give your FX wrap up for the past 24 hours of trading and now for what we can expect in the final 24 hours of this trading week. Now we have gone from one extreme on the fundamental scale to the other, looking for heavy levels of volatility to markets that were relatively passive. We've seen a changeover from risk-centric to monetary policy-centric and back again. All right. It is vital that we keep up with these trends because this is how we know how aggressive the markets can be, whether we're going to develop trends, whether we're going to have volatility events, and more importantly, what is driving our markets so they can keep it going. So, taking that big picture assessment of our market, I first look to the risk theme. All right, the S&P 500, as you can see here, for a risk gauge, is essentially spent this entire week in congestion. And we are in congestion at the very cusp of a much larger bear leg, potential bear leg. You can see here, with this correction having broken this rising trend line, we have pulled back to very substantial former resistance, now new support, and that's a confluence of many technical levels that we have around 1775. We're not able to break this. We have yet to be able to break this, but the market is not making much of a bid to actually make headway off of a rebound. The same kind of circumstances are seen in the equity indexes around the world. Nikkei 225, you can see this is a long-term trend line we're standing on here. The FTSE 100 for a European benchmark, same situation. Risk trends in general are steady, but they are not showing much in the way of improved circumstance. We can see a similar situation in the volatility indexes across the various markets as well. We have from these various markets, equities, FX, gold, treasuries, and emerging markets, these volatility indexes have stabilized. They're not rising rapidly anymore, but they are certainly not deflating like they had been earlier this month. So we do have an elevated sense of risk. How can we use that to our advantage? What does this mean in terms of trading? It means that we have a very sensitive market. It's easy to actually pitch the market into once again, a concerned run. Volatility surge, and our safe haven demand could rise once again. So we have to be very aware of those circumstances and be aware should they start to develop. Once we see it passing through into risk trends, we can be ready to act. Now, in terms of how we're measuring these risks a little bit more in depth, we discussed earlier this week the different steps, the different sensitivities these various markets have on the risk curve. So we were looking at specifically the scale of risk and what really starts moving with that scale. All right. Emerging markets are the most sensitive. Then we go up the scale to essentially markets completely demanding liquidity and looking for treasuries and risk-free assets. All right. Between those scales, between those bookends, we have the market. And as we see it right now, we're certainly in this area right here. All right. So when we look at the different measures, here we have the S&P 500, a benchmark for risk trends, one of my favorite. We know that we have that pullback and that congestion that we are now establishing on that major trend line. And it looks the same from a pullback circumstance. We have a 3% plus pullback from record highs, yet we are not escalating this to a more provocative correction, a more substantial correction, 5%, 10%. Obviously, the high water mark is a 20% correction. And this market certainly has the buildup to accomplish that kind of correction, whether we're talking about fundamentals like growth expectations, whether we're talking about relative yield versus the current price, whether we're talking about the backdrop for leverage and positioning, where leverage is at record highs and participation at 15-year lows. All right, the circumstances are there, but we need to see the market actually commit to unwinding its risky exposure, and that has yet to happen. In the meantime, let's look further up the curve. Let's look at risk trends in the emerging markets. We can see that the emerging market ETF, which is the purple line here, has indeed continued its pullback, and we are not bouncing yet, though we have not push to record lows. There has been a substantial move by the policy officials in the emerging markets to try to curb the volatility and the near panic that we have seen established there in the past week. This has worked to certainly stabilize the situation. It hasn't necessarily led to a meaningful correction. We haven't really seen the emerging market currencies rebound. Why? Because you're unlikely to see the capital flow back in, even though they hiked rates substantially, a number of central banks, even though they introduced capital curbs. That is not the kind of circumstances, that's not the kind of conditions that will draw investors back into those economies and those markets. So we're unlikely to see a very aggressive rebound, though we have seen some stories about some fund managers as well as some major investment outfits that are calling for some investment in these riskier assets. But this is a good indication and a good reflection of the same kind of circumstances we are seeing in equities. All right? And we're also seeing in the FX world. So moving up the curve to some degree from emerging markets, but on a similar level to equities, we have the yen crosses. These yen crosses have indeed turned to congestion, same as equities, but something like the dollar yen is going to be a little bit more active, a little bit more interesting. For the dollar yen, when we don't have a strong risk aversion theme and we just have kind of a mild drift in risk, we have a counter fundamental theme in the guise of the US dollar. The US dollar individually, as you can see here, has been performing quite well. It's had a pretty good run this past session. And this advance comes from other factors. So while we have the euro yen pushing to 2-month lows, where we have the Kiwi yen extending its decline, as well as the higher yielding Aussie yen and CAD yen, these pairs have broken very substantial technical patterns and subsequently held those former supports as new resistance. Good technical trades, very good technical trades. I know a number of you took these setups. Great setups. I didn't take any of these trades, but they ended up being great guidance. But from the dollars yen's perspective, we're not going to get that because it's not sensitive to that. It's not going to be the best sensitivity to that drift. We need concerted risk aversion. Otherwise, if we don't have strong risk aversion, that would pull all those yen crosses into the same kind of drive, into the same kind of theme. We're going to be falling back on the dollar versus the yen. And when it comes to that, yes, unwinding of a subtle unwinding of carry trade will indeed hurt the yen crosses and pull most of those crosses down. But the US dollar also is showing pretty robust demand, which is going to keep it buoyant. It's going to kind of work against, negate that negative drift. All right, so this is not the best yen cross if you're looking to trade them, unless you see a full-scale risk aversion theme to the downside. Much better in these circumstances is the euro yen, or even, if you will, the higher carry trades, but then you're going to be paying the rolls. So this is actually a better overall view. Now the euro yen is particularly interesting. This past or earlier this morning, actually, we had the release of a slew of Japanese indicators. Now the release of the CPI and the manufacturing and the housing consumption, those figures are all very noteworthy. I want to highlight the CPI figure. It came out better than expected, and at the rate that the inflation figure is actually running, 1.6% headline reading, this is the highest in approximately 5 years. They are, according to this measure, very close to their 2% target. Their target was to hit 2% and have a steady inflation of 2% by April of next year. All right, not this year, next year. Well, we're pretty close to it already. Of course, they can fall back and say they need to have the core hit that target, but realistically speaking, we're moving very aggressively to that situation. Now, this is important. Normally, the central bank could ignore this. It's not necessarily a Bank of England level faux pas in terms of the forward guidance versus what the market expects, but it certainly does introduce a new element of concern, because for the Bank of Japan, they are seeing inflation rise, but they're not seeing wages rise. So the cost of goods is rising. They're trying to beat deflation, but consumers Japanese can't afford the goods. So it creates a very significant economic problem. All right, this is something that could potentially discourage more stimulus from the Bank of Japan, and that big lead up into the first open-ended QE program, which saw such a dramatic advance from the yen crosses or decline in the Japanese yen, that might not be the case that we're going to see here. All right, we can already see the yen backing off of that pace that it had previously. All right, this is something of a significant concern, and is definitely going to help pull the yen crosses, or undermine the yen crosses' consistent run at this point. When we add to the euro side of this equation, the euro has been hit hard. In fact, this past session, Thursday, we saw a big drop in the euro dollar. You know that I was short this pair, and we had a big drop in this pairing, and it came back down to around 135.50. Now 135 is a much more substantial support level. If we are going to make a transition to just a pullback and this congestion, it's going to need to break that technical floor. So with my trade, actually, I've already hit my first target, about 125 pips. I booked that first half, and I trailed up the stop. All right, my stop is now actually at 135.65, so it's actually tighter than break even. My concern here is the upcoming event risk that we have in the European session. Scheduled for release, we have the unemployment rate and the CPI figures for the region. This is going to be more important because next week we actually have the ECB rate decision. We've seen some of those expectations of a upgraded stimulus program from the Bank of England, from the European Central Bank in the form of an LTRO-like program has eased back. If this data supports a need for more support, then we have a very good catalyst for potential euro decline. This would look fantastic for a euro USD break to the downside below 135. That would look great for a euro yen catalyst to the downside, breaking 138.50. Both of these look great for that. But we need that fundamental push. All right. If we do indeed get a technical support for a euro sell-off, and we do see the euro actually sell off, I will probably add to the short position. I'll add back up to full size for the euro USD. I'll treat that second half of the trade like a brand new trade. I may even add up on the euro yen, but you have to be careful because you don't want to leverage into a single trade. Even when they're different currency pairs, it can be based upon the same fundamental theme. And you have to be careful about that when they're highly correlated. All right, but this is a good setup, a very good setup. And one of the aspects that has really supported this move is also on the dollar side. Now, looking at the dollar, we have seen a pretty substantial rebound. And this is interesting because look at what has happened with risk. Risk has stabilized and it has seen, at least in this past session, a rebound in itself. So the dollar is rising even though equities have risen. How are we supposed to establish this? Isn't this the market's favorite safe haven? Well, we've seen this positive correlation between the U.S. dollar and general risk trends for some time, actually, for a number of months. And this relationship was initially perhaps expectations of the taper. We already know that the taper is being done. It's been implemented. But now we're starting to see it evolve into something along the lines of expectations for higher yield. So this is the 12-month interest rate forecast for the Federal Reserve versus the U.S. dollar index. We actually have a substantial upgrade to interest rate expectations. We're pricing in approximately 31 basis points worth of hikes over the coming 12 months. So the market is actually pricing in a full rate hike from the Fed. That is very unusual. That's actually very aggressive. That's actually more aggressive than the British pound. And you can see that it has certainly helped out the U.S. dollar, but even though we have this full speculation ongoing, it has not necessarily trickled down into outright dollar strength. If that were the case, we would not have a restraint at 135.50. We would see the euro dollar drop. If that were the case, that we were seeing a market fully speculating a rate hike, the pound dollar would not continue its march higher. someone pointed out earlier that this is a rising wedge formation. It absolutely is. All right, and it just and that's a rising wedge formation on this symmetrical horizontal wedge formation. So we have not seen the full scale of interest rate expectations filter down into the market. In fact, I talked about monetary policy expectations and how they impact markets, and some people get confused. Why is an interest rate higher on this currency yet this currency isn't rising? Or why is the central bank talking about rate hikes and it's not, and the currency's not rising? All right. The whole purpose of that video today is to explain this a little bit better in detail. But for the US dollar, we are definitely seeing an upgrade in those interest rate expectations. It is playing very well for the dollar, but it's not turning into bombastic growth. This is a very unique circumstance for the US dollar, where it does well in risk-positive markets. But should there be a severe risk aversion theme, what do you think will happen to the US dollar? It'll revive that safe haven appeal. It revives that liquidity of last resort status. And we will see the dollar rise, but rise in a more aggressive way. So we have essentially a heavy bias in favor of the US dollar from a fundamental perspective. That's a good opportunity. That is a very unique circumstance which we can use to our advantage to assess probabilities on certain trades. Now, in reference to the relative monetary policy for the Euro-USD, all right, we don't just look at the US dollar. Obviously, we will look at the expectations for the US dollar versus the expectations of the euro. We have the ECB due next week. We have the non-farm payrolls next week. Look at the Euro-USD versus its 12-month rate forecast for the Fed and the ECB. See how good that correlation is. Historically, yes, they do deviate, but they don't deviate to this extent. All right, this is very dramatic. This is an interesting and remarkable position to be in. We'll see what this means for the Euro-USD into the final 24 hours of this trading week. We'll see if that data on the docket actually generates more volatility, or maybe we have to wait until next week. But this is a very remarkable development. We can also say the same for the pound dollar. All right, the pound dollar, as you can see, it's actually pretty consistent with the differential in the 2-year government bond yields between the two of them. But this is a forecast from the Bank of England that is likely going to have to be resolved. We know that the Bank of England has really tripped up on its forward guidance. And either the forward guidance has to change, the Bank of England is going to have to be forced into an early rate hike, or they're going to dig in and they're going to reaffirm to the market they're not moving in 2014. They can do one of the two things. Bank of England has a rate decision next week, but will that change be made at the rate decision, or will they wait till the quarterly inflation report, which I believe is the week following? We'll have to see. This is going to be a very important aspect for the pound, and the pound has been doing very good, specifically on interest rate expectations. So this is going to be critical if you're trading any pound-based pairs. The pound dollar is one that I'd love to see break to the downside, but it has to break to the downside for the right reasons. For those that were watching the real-time news feed, essentially Wednesday evening to Thursday morning, we were looking for this short-term wedge break here on the 2-hour chart. It turned out to be a great break. Unfortunately, I fell asleep, so it wasn't a trade I could take. But you can keep looking for these shorter-term setups, because the daily considerations, the daily patterns, are going to be much more difficult to play out, to trigger. All right, because we're looking for those bigger fundamental themes. In the meantime, I do have a pound-based pair. I decided to take a short on the pound Kiwi. All right, it's underwater now, but you can see the bigger pattern that we're looking at here. Obviously, if we were playing this over, if I were expecting to play this for multiple months, it would probably be a better move to the upside. But as it were, I am playing it for shorter term purposes, and I'm seeing the top of this wedge formation and what is a triple top. All right. Now, of course, we have this rising channel, so this is a triple top versus a rising channel against a much larger channel or wedge. So there's a lot of confluence here for technicals. We'll see how this plays out, but the pound Kiwi has some very unique exposure where we're talking about technicals, but also fundamentals. Now, we talked about the relative expectations for the pound. We talked about the relative interest rate expectations for the dollar, in the euro. Well, the Kiwi has been very interesting. We know the RBNZ held its benchmark lending rate this past session, but what is very interesting is that despite there being 35% probability that they were going to hike that time around, meaning 35% of those that were in swaps had to reposition and were surprised, after that hold, the market essentially now is pricing in, not essentially, they are pricing in 100% probability of a rate hike in March. All right. Yet, look at how the Kiwi yen is performing after this realization that there's going to be a hike. Kiwi yen's down. All right, the Kiwi's down against most of its counterparts. Aussie Kiwi being a big one, as I said, one of my favorite trades of 2014. Starting to turn. But the Kiwi is down despite there being certainty that there's going to be a hike this year. Or sorry, at the next meeting. That's quite remarkable. And that goes back to what the markets are expecting and what they've already priced in. All right, so this is very interesting. We pit it against something like the Kiwi yen. Risk trends are going to become more important because we've priced in a lot of this. But if we look at something like the pound Kiwi, or if we look at something like the Aussie Kiwi, a lot of it's priced in, but it's priced in against other currencies that are potentially in a extended position. The pound being overextended to the upside, the Aussie dollar being overextended to the downside, and there's an easier argument to be made from a fundamental perspective. All right. So there's a lot going on in these markets, but the important thing to remember is that we're breaking it down into two general themes: risk trends and relative monetary policy. Risk trends are essentially on hiatus. They are turning more to congestion than they are a specific trend, whether bullish or bearish. Certainly not at panic or exuberance, but we certainly have a market that is exceedingly exposed to those kind of explosions in activity and sentiment. So you have to be very careful. In the meantime, monetary policy is a big consideration, and it's giving a lot of influence, or having more than its fair share of influence, on these major currency pairs. So keep it in mind, keep these fundamental themes in your head straight, and you will be in a much better position to place your trades and analyze your trades. We'll wrap you up for the week tomorrow and give you a forecast about what kind of fundamental drivers and what kind of technical setups are looking good for next week.